Vivid Box HQ breaks down why oil markets locked into a supply shock. On the morning of February 28, 2026, a joint American-Israeli military operation struck Iranian targets, and the world's most critical energy corridor went silent. The Strait of Hormuz, 21 miles at its narrowest point, the channel through which a third of the planet's seaborne oil flows every single day. Tanker traffic stalled within hours. The question that formed in trading rooms from London to Singapore wasn't whether oil prices would move. It was whether they'd stop. Watch that orange line climb. $78 a barrel on February 27th. 85 by the end of the 28th. 91 by March 1st. 95 by the 3rd. $17 of geopolitical premium, locked in over 5 days. China lost 13% of its seaborne crude supply overnight. Not gradually, not through negotiation. Overnight. That number, 13%, is the thread that runs through everything that followed. Every failed diplomatic channel. Every upward inflation revision. Every central bank caught between bad options and worse ones. The disruption was military. The damage was economic. And it was only getting started. Pakistan made the call in early April 2026. With Turkish and Egyptian backing, Islamabad positioned itself as the bridge between Washington and Tehran, a country with military credibility on both sides, trusted by neither fully, needed by both desperately. Oman had already tried. Geneva, February, quiet talks, careful language, Omani diplomats working a channel they'd used for decades. It collapsed on the same fault line Pakistan would later find: insufficient leverage to close the gap between nuclear verification demands and Iran's conditions for standing down. China offered to facilitate. Russia offered to mediate. Qatar, a state that has spent years maintaining cordial ties with Tehran, pursued its own approach. 3 separate mediators. 3 separate frameworks. 1 identical result. The problem wasn't the messengers. It was the math. Any stable resolution to this crisis delivers more strategic advantage to Washington than to Beijing. China knew it. Iran knew it. And that meant every channel eventually ran into the same wall. Vietnam didn't start this war. It shares no border with Iran, has no naval presence in the Gulf, imports nothing through military channels. It didn't matter. By April 2026, analysts had revised Vietnam's inflation forecast for the year from 3% to 2%, nearly a full percentage point, driven almost entirely by oil running $17 above every pre-disruption model. Belgium moved from 3% to 4%. Diesel and LNG surged more than 40%. Plane tickets, 41.5%. Transport alone added more than a full percentage point to Belgian inflation in a single month. See that gap between the bars? The gray column is where analysts thought 2026 would land. The orange is where it's going. Vietnam carries the largest revision, but look at the uniformity. No economy revised down. Not one. India, Japan, Turkey, South Korea, economies with structurally longer import chains and fewer hedging instruments. The exposure runs deeper there. The adjustment will run longer. This isn't a price shock. It's a rewrite of 2026 economic calendar. The week of April 13th, 2026, Beijing hosted a flurry of top-level diplomatic calls, China's foreign minister reaching counterparts from Tehran to Brussels, positioning China as the stabilizing force in an unstabilized region. The optics were deliberate. The leverage was not. China lost 13% of its seaborne crude overnight, and then tried to broker peace in the crisis that caused it. That's not hypocrisy. It's the bind. Any resolution that reopens the strait on terms Washington can accept delivers more strategic benefit to the U.S. than to Beijing. China wants the crisis to end. It cannot control how. Watch that stacked bar. The orange slice, Iran's 13%, vanishes entirely by May 2026. Russia absorbs the gap, but not as a favor at market rates in a tightened global market. China's strategic reserves, roughly 3 billion barrels, or 110 to 140 days of import cover, buy time. They don't buy leverage. Iraq is China's third largest supplier, but Iraq's infrastructure faces its own disruption with the strait partially blocked. That relationship has a ceiling. Right now, the ceiling is geopolitical. Every inflation forecast built in March and April rests on a single embedded assumption. The conflict winds down by May 2026. Prices moderate mid-year. Inflation proves temporary. Central banks hold. It's May 16, 2026. The assumption is still unverified. If de-escalation happens, genuine de-escalation, the strait reopened, tanker traffic restored, the oil premium bleeds out. The inflation revisions reverse in the second half of the year. Manageable. If it doesn't, the math changes entirely. An extended blockade into Q3 locks inflation above pre-disruption trajectories through 2027. Central banks that spent 2 years threading the needle between growth and price stability face an impossible choice: raise rates into a softening economy, or hold rates and let inflation entrench. Analysts tracking the upside risk scenarios put the asymmetry plainly. If the conflict continues longer, the risks only tilt one direction. The fork in this road arrives by the end of this month. Not next quarter. This month. If the Hormuz closure ends by June 2026, the math reverses. Oil slides back towards $75 to $80 a barrel. The inflation revisions from March and April start unwinding in H2. Central banks hold. China quietly resets its relationship with Tehran. Emerging market currencies stabilize. That's the clean exit. The second path is the one that keeps central bankers awake. Oil sustains above $90 through Q3. Every inflation revision from March becomes a floor, not a ceiling. Turkey, India, South Korea face rate hikes into contraction. The condition economists call stagflation, and ordinary people experience as prices rising while jobs disappear. Currency crises become probable, not possible. Probable. The third path isn't a scenario. It's a category failure. Saudi or Iraqi infrastructure becomes a target. The assumption of containment breaks. No model survives that intact. 3 futures. 2 are manageable. 1 ends the framework. The world is inside all 3 simultaneously, waiting to find out which one wins. If you're tracking oil, inflation, and geopolitical risk, this is the breakdown you need. Hit like, subscribe for weekly deep dives into how geopolitics reshape commodity markets and global trade. See you tomorrow.